And he's got a whole list of charts, technical things to look at. Yoav, as usual, it's good to have you here. Let's start by just first addressing the NASDAQ, as we've got leadership there focused again. Just how lofty, just how expensive, how does it compare to history?
Names have had quite a run here throughout the year. It's been a lot of, crowding, if you will, or concentration in the markets. Some of that's come through in just the general breadth of the market so far year to date. But certainly we've gotten to levels that, the last time around was during the tech bubble. So that's a good frame of reference to know just how far these names have run.
So on a forward basis for earnings, we go back to roughly the 2000s. Is there something to be said about the using forward earnings right now? I mean, there's just so much in flux. I mean, have we ever had as much uncertainty for forward earnings? We did just beat the heck out of this quarter's expectations. Could this valuation easily drop?
Well, I mean, obviously it could happen. I think the big distinction between today and what we saw at the beginning of the century is just the type of companies that make the NASDAQ, or the tech bubble, if you will, or lack thereof. I mean, these companies today are much stronger, much larger, cash flow generating, a lot different than what we were seeing back in 99 and 2000 leading up into the bubble. But certainly there's been quite a run in these concentrated tech names. They have great positioning. They have defensible moats. They have strong positioning, and we've seen investors flock to those companies, particularly as we are going through this uncertain time.
Yeah, we see the NASDAQ again today leads the charge, but we've also been watching for the last month this back and forth between the NASDAQ and the Russell. Even when it looks like it's clearly going to break towards tech again, then we have days like yesterday where yields climb and the Russell's the only one in the green. Where do you stand on this, Yoav? What's the latest in the way your team is watching the potential or the flirtation with rotation?
Yeah, we're very cognizant of it. It's really important, obviously, to be not caught wrong-footed. We've had a few of these rotation episodes, if you will, but they've been very short in the general trend of what's worked has continued to work. Particularly if you think of growth versus value as an example. Certainly, small caps year to date have lagged both the S&P and the NASDAQ, but we think that's more of a function of companies that are reliant on the credit cycle, companies that keep funding. Kind of, if you think about the bifurcation in the market, we've really established haves and have-nots. So the large tech companies that we spoke about, the large retailers, the companies that can access capital markets, companies that are maybe more tied into small, medium businesses or industries that are more impacted by COVID, whether it's gaming or leisure, things of that nature. So certainly it's something that we monitor very closely, particularly as we continue to see this bifurcation, not only in equities, but also in the credit market as well.
Okay, so the Russell underperforming, companies that are a little bit more dependent on a real economic pickup perhaps. Right now, as we make those highs, the concentration has been really one of the big focuses. Breadth is very low in the S&P 500, if you measure it in a number of different ways. What does that mean to you? Is there something to be said about the thinness of the market right now?
Yeah, look, that vacillates obviously over a full cycle. I think it's notable right now, particularly if you think about the S&P. I think came across an interesting chart earlier this week where the breadth of the S&P is showing that still nearly 30%, 29% of constituents are in quote-unquote a bear market in the S&P 500. The last time the market was at these levels, early to mid-February, that number was 1.2% of constituents. So certainly what's been driving us to get to this 3,400 level is far different than what it was pre-COVID. It's not surprising. It's a huge exogenous shock. It has a lot of ramifications. As you've noted, tons of uncertainty still remains. So it's not surprising, perhaps, that investors have concentrated in select few areas that they think will work. The question is, will it continue to work? Certainly, or I shouldn't say certainly, but I think that there's a good case to be made that on the back end of COVID, hopefully we get a vaccine as soon as possible, but how the rest of the economic growth and trajectory from here will not look like what it's looked in the first 6-7 months of this year.
Yoav, there has been a real focus on the COVID count, but what I've noticed is it doesn't seem to be quite as exciting to discuss for market participants when it's a good thing. When the COVID count was going up, was all I ever heard about. The need for more fiscal outlay, the chaos that was going to be, wreaked on the remaining companies that were trying to reopen. But even in the hot spots, it's turning around just about everywhere. Florida and California, maybe you can still make a case, we don't know, but even recently those have turned lower. So is it a matter of time before that becomes a conversation again that is catalytic to the market, that is going to be an important economic impulse, or has it been priced in that the curves are going to go down? I mean, the curve here is just, it looks great, frankly. It is going exactly where we want it to go after the summer flare-up. How come this isn't showing up over in the markets the last month?
Well, I think, the market is forward-looking, so some of that sort of was priced in. Everyone would welcome continued better data on the pandemic front. Economic activity needs to pick up and kind of continue to show the momentum that it was showing in May and June. I think in July, that pause is starting to seep into the numbers. We saw some this morning as well with initial claims. I think if we get back toward containing the pandemic, obviously if we get a vaccine, then it's going to be a huge boost to the economy. I think the focus will continue to shift. We also have the election upcoming. There's a lot of uncertainty surrounding that. I think market participants, given the significant and strong run we've had from the bottom, in the depths of the pandemic, I think a pause or a digestion period is healthy to at least acceptable.
Do you, as an investor, and should portfolio managers keep one kind of foot in that potential for downtrodden companies to reverse? Another chart you have looks at the percent of the S&P in a bear market. It's quite a few. We know a lot of these companies are going to be those tied to economic recovery. So as those curves come down, I mean, even if some of that's been priced in, do you have to kind of have some exposure to these companies and maybe just follow the market and add on the more obvious it becomes that there's real recovery happening? Because there's a lot of companies here that look like they could potentially get a bid, right? I mean, you've got like 30% of the market still in bear territory.
Yeah, and I think a lot of those participants are awaiting some more clarity. So, obviously the uncertainty this year has been unprecedented, but as we understand not only the pandemic, but ultimately, whether more fiscal stimulus is coming, more monetary stimulus is coming, and then just what the cadence and what the new world looks like after we come out of this pandemic, I think that'll be really important in terms of dictating that. With the approach that we've taken is, obviously you can have exposure, you can have participation in that angle of the market, but equally as important is maybe getting the watch list, getting the names that you really want to get involved in ready for when the uncertainty lifts up. We invest for the long term, but we also invest looking for high probability of success situations. In our venture fund, we're looking for not only good view, good downside to upside risk reward, but also conviction around the outcome that we're playing for in full. So obviously with so much uncertainty, both from a health crisis standpoint, but also from an economic standpoint, that becomes difficult. But certainly as that uncertainty lifts or wanes, that provides a lot of opportunity for a lot of companies that are discounting quite a bit of uncertainty. Okay.
So you just still have to get the uncertainty to resolve itself to some degree for those companies. One of the other charts that you have is implied correlation. Walk me through how you use that as a way to kind of gauge either the potential for dispersion in markets for companies to go their own way. Is it a macro indicator? Because it looks like we've dropped down to levels we haven't seen since pre-COVID.
Yeah, we like to use the correlation observation and data, particularly implied correlation in the S&P, but also across asset classes, really to get a sense of, as you noted, is there enough dispersion for stock picking and to truly differentiate oneself, but also just to get a sense of the level of heightened trepidation, if you will, in the market. So obviously when the VIX is skyrocketing and implied correlations and correlations across asset classes are moving towards one, there's really not a lot to be done in terms of differentiation. As that subsided, now we've basically unwound all the heightened correlation period from COVID, if you will, and the economic damage. So we're back to, January, February levels. That's a more fertile environment to be able to identify unique situations, whether it's through asset classes or companies. And it's an indicator that we use in order to just get a sense of the type of environmental regime we're operating in.
Right now, lowest since before the crisis. Regime may be trying to change a little bit, but one of the things, the last one I want to end on, is just your thoughts on how the market has crowded together. You've, in your report, you talk about hedge fund crowding, overall market crowding. Where are they crowded? Is it in the big five? Is it in the big tech areas? Is that making it more dangerous?
I don't know if it's making it more dangerous, but it's certainly something to be cognizant of. I think it also sets up for potential short-term reversals or rotations, as we've seen. So that's something to be cognizant of. But certainly, it ties in with the lack of breadth in this market, which, can be sustained for quite a while. But it's something that we need to, we stay focused on and investors should be aware of. Obviously, you have a lot of dollars going after this similar stuff and in a narrow set of investments. So to the extent that there's any sort of shift or change in the market, that just makes you more susceptible to those kind of rotation pains.